With the presidential election now behind us, you may be wondering, what are some things that I should be doing in my portfolio to protect it coming into this new term?
And we want to answer that by looking at several different charts that Ben and I have compiled together.
So as Daryl shared, as we're getting into this, we're going to share a few different charts with you that hopefully answer the question of what you should be doing in the coming year. First chart I want to share with you guys is actually the makeup of the S&P 500, historically speaking, obviously, with a division of Senate and Congress, right, and under a Republican president, since we know the election results of the Republican presidency. Something I think to note, as of right now, as the filming of this, we don't necessarily have total clarity on Congress, 214 to 205 with 16 votes left uncounted. So 4 votes off of a majority for Republicans. Something I love, and I highlighted in here too, which I think is great and hopefully brings you some peace, if nothing else, is that markets really do not favor a specific party when it comes to who is president. I know we all have our own biases one way or another, but the market doesn't care. At the end of the day, the market really cares about corporate profits, right? And so regardless of who is in office, we historically see under a Democratic president a 13.6% annualized rate of return in the S&P. By the way, this goes back to 1933. You can see that on the chart that Matt has up right now. Under Republican president, 13.7%. That's with division in Congress, right? Even under that, a 12.9% annualized rate of return. Very solid returns since inception, again, going from 1933 to 2022, excluding kind of the dot-com burst, it looks like in here. But anything that you want to say in particular on this particular chart?
Well, I think, one of the things that we want to address is just what has happened around the election itself. And there was just so much volatility leading up into that, and then there was so much money moving after that. And so I think people were thinking, man, are we missing something? Should we jump into a certain sector? Should we go ahead and align our investments according to what we think that the overall administration is going to do? And what this chart shows is really, again, it's not necessarily the policies of the president, it's actually what's going on in terms of the lawmakers in the House. And so with that, we've got a solid investment scheme.
Yeah, well, yeah, you can have best intentions if you don't have control of all three, then you're not getting much done in the way of policy.
We talk about a lot of different things. One of the things that we always say is it is time in the market. It's not timing the market, right? And so that's important in terms of this next chart as well, because what we want to show here is for long-term investors, it's important, historically speaking, that the political structure in Washington has not had too much of a discernible impact on equity market returns. And so what we're looking at here is what have been the returns of the market 1 year after any one of these presidents has been elected. And what you see here is it's not by party. I mean, really the only outlier here is in 2000, which we know all what happened, right? And so, that completely burst and went negative. But if you look at the 1 year returns, regardless of whether that's a Democratic presidency or a Republican presidency, we're seeing that those returns are solid, right? Yeah. And there's no real discernible way to say which one is going to do the best. So anyway, from me, I look at that and I think, gosh, what we should be doing is making sure that we're currently invested and we're following what that strategy has been, because we know that 1 year out, we're going to start to see really solid returns. So what do you think about that, Ben?
Well, I think there's a couple points. This also ties in with the second chart, which we'll get to in a little bit. And for two different reasons. But I think folks fear, right, when the market has run up as much as it has the last 2 years and it's done so well, like we're just now feeling the effects of some of the policy that had been enacted that was stimulative, right? And now we've just gotten to the point where the Fed's cutting rates, right?
Yeah. But we're still seeing recession.
Yep. Yeah. We're hearing recession, but maybe a soft landing. Maybe the Fed is navigating to a soft landing, not the hard landing type recessionary scenario. Recessions are something we're supposed to get, just this little off topic. Like, we are supposed to get recessions. We are supposed to get pullbacks. These are part of the market.
It's part of the investment.
You have lived through them. They are part of the investment strategy, and we'll show you later on here in one of the quilt charts what that looks like. Going into this next chart here, what's interesting about this is it doesn't have to do necessarily with an election year, right? But whoever is going to be inheriting the office, which we know now is going to be President Trump. I heard them on Bloomberg this morning say President Trump 2.0 here, second term, right? So we'll be inheriting a strong market as we speak right now. Unemployment still low, has crept up a little bit. Fed is dropping interest rates, so interest rates are coming down. I haven't looked at new home starts lately, but that's always a pretty clear indication of the direction.
Yep.
Okay, increasing, right? So a lot of positive things in the markets,
right?
And so the public markets specifically, right? We've seen a 40% run up in the markets, and this is an interesting stat, and I'm going to read from it just to make sure that I get it right. So this is actually from the Leuthold Group, that at previous episodes, when the S&P was showing similar momentum to the extreme readings it's giving off today, it found that in 21 previous instances, when the index was sitting on a gain of 30% or more over a 12-month period of time, and again, it's at about 40 right now, only twice did the economy falter in the following year, right? I think that's a pretty staggering stat. 19 out of 21 periods of time in which we've had this type of run-up, twice did the following year stagger. Couple that with the results of the previous chart, a 17.6% average in a post-election year. That speaks pretty well, I think, for the market in general with the fundamentals that we're seeing right now.
Absolutely, and it really does shock the system, because we typically are saying, hey, buy low, sell high. There's also an argument, though, to be said for buy at the high, because there are times when it springboards forward. Not that we're necessarily saying, hey, let's be bullish about this, but there are a lot of things that indicate, hey, we can have some confidence in what's going on.
And all of this, I say, consider your time frame too, right? If we're talking a 3 to 5 plus year time frame,
absolutely,
certainly. If you're like, this is money that I'm going to need in the next year or two, let's not go take any massive risk for it, right? Interest rates are still nice on cash.
Yeah, exactly. Right? So, well, that's a great segue. Perfect segue into the next chart, because what we look at here is now what is a 4-year cycle in terms of returns. And so what we see here, again, is based on presidential cycle returns, markets typically have an interesting pattern. And so it's that first year we get to see, hey, there's a little bit more of a bump. But in the second year, there are lesser returns that are going on. That third year spikes up a little bit. And why? Well, largely because policy, I know, exactly. Policy starts to get enacted. Oftentimes, that's also a Senate or a House year. So there's a little bit more going on in that as well. And then it draws back just a tiny bit in the fourth year. So all that to say, timing and time frame is critically important. And it's also something to just go ahead and moderate your expectations. You know, this is not necessarily, hey, to the moon, right? This is saying, hey, we are in good shape, things are going on, but just be aware of the fact that the cycle itself can continue in a way where then we get to see a diminished return.
A bit of a retraction. Yeah. Which again, just to reiterate, pullbacks are normal, and right? They should happen, right? They create opportunities in the market, right? And part of the next chart we're going to go to speaks to that, right? In the form of diversification, right? It's important to have a diversified portfolio, because I know this is just a big surprise to everyone. Sometimes we're wrong. Sometimes we don't get it right every time, right? Which is why we run a diversified portfolio, right? And this quilt chart, I think, is really interesting. You're going to see in the center of it, the gray box. That's a diversified portfolio. It's going to show you basically the largest asset classes and how they have performed in a given year. What I think is interesting about this chart is the lack of correlation in asset classes, right? The only correlation I see is that a lot of the time, the top performer is the bottom performer in the next year, and vice versa, right?
So if we look at this, and we look at this from maybe from the lens of what should I be doing right now? Ben, tell me what should my portfolio be doing? And we look and we say, strategically, we're looking at this long of a time frame. We're looking at truly making sure that we're capturing things and we're protecting you, right? In terms of your investment portfolio. You know, should you be buying a specific stock? Should you be buying something that aligns with what is hoped to be the policy that will take place, or begin on January 20th of 2025? Not necessarily. A lot of the bumps that we saw post-election, that's because money was sitting on the sideline because people didn't know quite what to do. When I look at this and I think, hey, are you missing out? No, you're really not. Why? Because our investment strategy is solid. We're aware of your time frame. We're aware of your hopes and your goals. We're working towards your index, right? And for me, probably the most
financial planning is all about.
It's what financial planning is all about. And so, does that mean that we just simply say, hey, just keep going? No, because we're doing our due diligence in the background. We're looking at all of these things. We're looking at what might those impacts be. We're making recommendations accordingly. But it's not to say, hey, you know what? We need to be reactive right now. That's not a good investment strategy.
As always, if you have any questions or you'd like to sit down with us to review your strategy or your financial plan, we're here for you. So please reach out. We're always here.